My name is Adrian Pask, and I'm the Chief Investment Officer at PSG Wealth. So obviously last night we saw some downgrades from the S&P. In terms of contents for this presentation, to cover our views on that specific event, this is the contents for the slides. Rating reviews, the rating factors, our base case, the relative ratings in context of emerging markets, and the market and currency movements. And then we'll finish with the bottom line in terms of what we think the best possible approach is right now. The presentation is quite snappy, given that the content's also being circulated by social media. But for people who would like more detail on this discussion, we've included some frequently asked questions, and there's an extended copy of slides available as well. So I'll give you the details right at the end for our marketing team. You're welcome to contact us if you would like that additional information. In terms of the rating reviews, so obviously the S&P cut the local currency rating down to non-investment grade, so that's similar to what they've done on the foreign currency rating already. The rationale behind the move was largely on the back of weaker GDP growth at the moment, and then obviously some additional expenses that's expected to come through, not least of which is the higher financing costs on existing debt structures. If you then look at from Moody's side, from what they came out was with a review for a downgrade. So our hope was that they would affirm the existing ratings, but unfortunately they have now taken some time to perform some additional work, and within the next 30 to 90 days they'll come with their view in terms of where they see the South African sovereign from a credit rating perspective. From Fitch's side, they already affirmed their existing non-investment grade ratings on Thursday and maintained their outlook as stable. Just to put those ratings in context, so above the solid line here would be the investment grade. So there's even additional, obviously, some categories in there to distinguish between lower, medium grade and prime and high grade, etc. Where we find ourselves now is on this non-investment grade speculative side. It's still not far away from the highly speculative or the regions with substantial risk. So we're finding ourselves, at least in a global context, somewhere in the middle. From an economic perspective, what is going to happen to South Africa now that this downgrade has taken place? The government may struggle to raise the funding for some of their projects. Yields on bonds should move higher to compensate investors for the additional sovereign risk that they're taking. So exactly the same as what a bank would work in terms of someone who applies for a loan. If the risk is deemed to be high, then the interest rate will have to be higher in that sense as well. There will be some added pressure on the national budget, and then ultimately taxes will have to be reviewed. Corporate financing costs will increase in line with what's been happening at the base in terms of the sovereign risk. And then obviously that could place pressure on earnings growth as well. From a currency perspective, the rand already weakened on the downgrade news, but it's likely that we'll see some additional poor sentiment playing through in the early stages of next week. In terms of rating factors, what does the S&P consider? They compartmentalize certain factors into these 6 buckets that you can see here. We'll touch quickly on some of the key weaknesses in terms of the economic assessment and on the fiscal side, on the monetary assessment side. So that's largely the work that the MPC is doing in terms of monetary policy. That's deemed as a strength. And then the institutional assessment in terms of media and policy, those are largely seen as neutral at the moment. So some working, some not working, but nothing really justifies a rating in terms of a weakness or strength on that side. In terms of the debt burden, it is actually getting quite bad. I don't think everyone necessarily seen some of these metrics. So I'll show you exactly what it is that the S&P looks at, what that concerns them. So they've got the top red line here, looking at general government debt as a percentage of GDP. So the debt base is increasing, and then the interest as that needs to be paid to finance that capital loan as a percentage of general government revenues is also then increasing. So a more significant portion of the revenues that we do get in is going towards our financing cost on the debt side, which is obviously not positive. Our base case, like I alluded to, was really for the S&P to downgrade and for Moody's to affirm. That didn't really materialize exactly like that, although fairly close. On the bull side, it would have been great if both agencies could affirm their existing ratings as what they were, and we could go on. But unfortunately, the assessment didn't result into that. On the bear case, however, Moody's could have very easily downgraded on the back of S&P's response as well, and at least we managed to avoid two simultaneous downgrades, which obviously would have very negatively impacted on the sentiment side. In terms of what we expect markets to potentially sell off early next week. We expect the bond yields to shoot up. The rand could initially actually depreciate further out, but the rand is actually, in our view, actually quite weak at the moment, and also the bond yields are offering way too much value relative to some of the other non-investment grade peers that we do have out there. And on that specifically, this is the other non-investment grade countries that are rated similar to ourselves, and you can see South Africa fits in right in the middle there. So at least the rating seems fair from a assessment of finances. But if you look at how the pricing is taking place for bonds in terms of the sovereign risk premium, other countries are actually at a lower sovereign risk premium with what South Africa is. So we are actually from a sovereign risk premium point of view, seen in lower regard as what we actually are. And that's where the mispricing comes in terms of opportunity in the bond market. So, and that's also why we believe there's potential there for bond managers to pick up assets at attractive yields that are perhaps not fairly reflective. So from a currency perspective, we saw last night the rand domestically was trading at roughly 13.80 at around 6 or 7 o'clock, and that now since overnight, so that the news of the S&P came through at 11 o'clock last night, and there you can see the weakness coming through at 14.50. It was trading at. And what we expect going forward, like I've alluded to, especially on the bond market side, is this is a historic assessment of what's happened to other countries that went through exactly the same process, so before and after the downgrade. And generally what you would see is for yields to pick up leading months up to the actual downgrade taking place, and subsequent to that is actually for yields to come down. So that means if you can find an opportunity to actually find attractive yields at this point in time, it is almost ironic in the sense that it isn't exactly what you would expect to happen, but it is because markets are fairly forward-looking and they can anticipate where these yields should actually be placed, and then after that, obviously, it normalizes to where the long-term fundamentals is as sentiment starts to dissipate and fundamental analysis starts to come through. So the bottom line from our perspective, there's a lot of work that needs to be done in terms of unemployment, education, investment, all those things that we talk about all the time. Financing cost is a real concern. The contingent liabilities that have been taken over on some of the SOEs, that remains a concern. And then spending for growth is also something that concerns us. From an investment perspective, however, there are some opportunities amidst all these risks, and poor sentiment really does offer you frequent opportunities in most capital markets. So we think that the astute portfolio manager, fund manager, will look for opportunities in the coming weeks, and we'll be doing exactly the same to see how we can manage the risks and mitigate the risk, but at the same time keep in mind that there might be some opportunities out there. From a client perspective, investment perspective, I think the best to do is not to make emotional investment allocations, and just trust in if you have allocated according to your financial plan, trust your financial wealth manager and your fund managers to do the heavy lifting on the investment side of things. Frequently asked questions, like I mentioned, is included here for guys who would like a copy of the presentation. And in terms of contact details, you can contact this email address reflected here if you would like additional copy. or information. So we've got an extended deck of research on this specific topic. Like I mentioned, we kept it fairly brief for the purposes of social media, but a lot more available on the specific topic. And then please follow us on social media for more regular updates on these type of events. From my side, thank you very much for joining us and watching the video. Appreciate the time.